The biggest focus of this week was the GST rate rationalization, which in a way helped the markets regain most of last week's losses. The sensex and the nifty were up about 1 percentage point each, except IT. All the sectoral indices recorded gains this week. In today's edition of Editors Roundtable, we'll decode the GST rate cut across the different sectors, what's causing the rally in metals. Hello and welcome to Editors Roundtable. I am Reema. With me are Prashant, Nigel and Nimesh. And the special guest here with us in the studio is Mihir Bora of Trust Mutual Fund. Hi guys, big week, but the index is up only about 1%.
1%, and I have the stats here.
And this is despite such a big news, right?
Such a big landmark
last week we had a
reform.
very big GDP number and still market didn't react. This week we had a very big GST rate cut and market didn't react. So in a way, a bit of disappointment, I would say that
Similar
despite
to
bad
actually
news,
last week.
despite
Similar
good
to
news,
last week.
Yeah, despite good news, we are not reacting as a market.
Yeah.
But the mid-cap index did well. That was up about 2.5%, and individual stocks like M&M, etc., up 11%.
You know, Warren Buffett, back in the 60s, I think it was the 70s maybe, and it's on YouTube, you can go and check it. I think this was the first or the second interview, televised interview. He was asked, I think the market had done very well or done very poorly. So he was asked by the reporter, why is the market behaving so irrationally? So I'm paraphrasing, it's not the exact quote. He said, well, the market is behaving this way because it is correcting an earlier phase of irrationality. So I think, a lot of pre-positioning.
Yeah, pre-positioning.
Especially with regards
We saw
to
this in
GST.
FMCG index this week, right? I mean,
yeah,
FMCG index, auto
Nimesh,
index.
as we were saying, autos, Nigel, autos 7% gain.
Yeah.
14th of August, from
Correct.
right before the Prime Minister's speech till 2 days
now.
back.
Yeah,
7% on consumer, 4.5% on FMCG. So yeah, I mean, but your point is right. I mean, generally there is a general sense of disenchantment.
Yeah.
Paisa nahi ban raha, paisa lag raha hai,
You should ask Mir what to do.
Paisa bana?
Depends on where you start from. The recent bottom was March 3rd.
Yeah,
The NSE 500 is up 14% since then.
correct.
The mid-cap and small-cap indices are up almost 25% since then, right?
Yeah.
And some of the funds, if you look at the NAVs, they're up more than 25-30%. So it's always half full or half empty, isn't it?
I mean, just time correction, I guess, Reema.
But it's been going on for a year, right?
For a year, for 1 year. But the point is, as Mir said, right? I mean, market went up how many times? 8,000 was the low, right?
Yeah.
Forget the low. I'm saying from 12,000 on a normalized level, it more than doubled. And that's the index. Stocks went up, I mean, multiple times.
What was the most interesting thing for me? I mean, because I was at the conference in Motilal and I met a lot of investors, both domestic and foreign. The foreign investor positioning seems to be the lowest in India, ever. But when I talk to some big fund managers there, and the feedback seems to be, this is the time to buy now. I mean, I was having somebody like Nitin Jain on record saying that, there is so much of pessimism that you should buy this pessimism. So the opinion is different and the action is quite different. So in a way, it's a divergent view, I would say, within the FIs.
Nimesh, on that note, this is not my data, this is Bloomberg Intelligence. And the other side of the story, right?
Yeah.
You're absolutely right. Positioning-wise, huge underweights.
Huge underweights, extremely low
But
levels.
Bloomberg Intelligence put out this table, and it's stunning, actually. We should have put it up. The percentage share of stocks with PE ratios greater than 50 times.
Yeah.
In India, on NSE 500, 36% of NSE 500 stocks have got PE ratios of over 50. It's all relative. I mean, you've got to look at other markets. Indonesia is number 2 with 19%. So we are double the next country in that sense. So it's still 1 year of time correction.
Correction.
PEs are still... Is that a problem, Amir, as you look at it?
See, the point is, NSE 500 is a very wide index.
Yeah.
So half of them are small caps, right? And you've been to the recent Motilal conference. We also keep meeting companies. It's been conference seasons for the last 3 weeks or so, The point is that if you meet individual companies, you always come back bullish.
Yeah.
Right?
Yeah.
If you just... typically in conferences, what we do is we try to meet the smaller companies. We don't really meet the large caps and the mega caps and all that because there's not much to be, known new. But when you meet the small cap companies, the mid cap companies, the kind of work that is happening, the kind of investment, the kind of growth that we are looking at is amazing. So enough scope for stock picking out there.
Yeah, the undertone seems to be still bullish with the corporates as well. That I take it. But again, Mir, from a investor sentiment point of view, see, the biggest threat to this market has been the retail flows. Any sense of that tapering off? Because I'm getting some sense that maybe on a monthly basis, that number may look slight weak. So what's your sense in terms of the
I don't see SIPs slowing down.
Okay.
Okay. And SIP
Are we going to see a record month again?
I think so, because the number of if you look at all the the MFDs and IFAs, their momentum has not stopped.
Sure.
Typically, the net number tends to be get mellowed by the chunky outflows, so to say, which is typically older investors or HNIs, moving in and out, or to some extent family offices and corporates. But if you look at the SIP number, that's only part of the story.
Sure.
Structurally, we have the other components which are also continuously growing. For example, insurance premiums. Right, especially LIC and all the big ones, they continue to get money every month. EPF, that's the structural inflow now. NPS is a structural inflow.
Correct.
So it's not only about the financialization of savings, is not only about mutual funds anymore.
True.
And the retirement pie and the insurance
And
pie
that number
will
is
continue
big.
to grow.
That number is big.
And growing continuously.
Yeah, it's a $50 billion, right? I mean, annually that you can.
Plus, the finance ministry and the government has already allowed larger allocations by the pension funds into equities. So that flow is something that we haven't even seen yet.
So just, let's begin the conversation about markets and where we're headed with a broader construct. I mean, what's the call now on the market, say for the rest of the year, your portfolio positioning? And now everyone's saying, right, the catalyst for the market is always earnings growth, which has been subpar. Do you think with what we've seen in terms of GST reforms, we can get to that double-digit, mid-teen kind of earnings growth, or it's still not enough?
See, first of all, again, single-digit earnings growth is only for the Nifty 50.
Yeah.
Right? When you talk about the NSE 500, all those small cap and the mid cap indices, the earnings growth was anyway good. Anywhere between 12 to 17%, depending on which index you are looking at. Okay. So the broader market earnings were always better than the Nifty 50 earnings. So that's one very clear distinction in my mind. And I always believe, that the broader market is likely to continue to be more exciting than the Nifty 50 market. So I think beyond a point, we should not obsess too much about the Nifty 50. So 12 to 15% earnings growth we were going to see in some of the broader indices in any case, and the small mid-cap indices. If you look at the results season, the mid-cap index has shown positive earnings surprises, right? And the earnings growth has been quite good in the mid-cap index. So that's another component that we should also be aware of. So I think the consumption boost that has been given is genuine. There is price sensitivity and demand, I would say, is very elastic to prices at those price points. I mean, if you cut taxes at the HNI level, it's not going to result in immediate consumption.
Sure.
But when you cut the prices of a soap or a shampoo or a small car, it does have a elasticity of demand. The propensity of marginal consumption is very high.
Sure.
So I do really see an improvement not only in consumption demand,
it's time to buy the mass
but also in corporate margins. So your question about double-digit earnings growth, I think is very much feasible.
Feasible now, yeah.
So, Nimesh, you were
So I just want to ask you that, so is there time to buy mass consumption? Is that something that you'll bet on in your portfolio as well?
I would still go for the discretionary consumption.
Okay.
Mass consumption stocks like FMCG, etc. Anyway, we're pricing in because the PEs of those stocks and all. So maybe you have a 5, 10, 15% upside there. Sure. I think the discretionary consumption, especially the urban link, I would say the new age companies where they cater to consumption, those may actually benefit better.
Okay.
And of course, things like auto and all.
We put this data out earlier that if you look at, is there a net earnings bump up, you think, which
there will be earnings bump up both on the volume improvement side as well as on the margin side. Because not only do you have GST cuts at the top line, so obviously it becomes more affordable and you get a volume
goes up, say 4-5%.
Yes.
But price is passed on. So it kind of negates, right?
Yes, but in a lot of the cases, for example, in the case of auto, there was inverted duty structure which has been corrected.
Yeah.
So you might actually see a pass-through of margins also.
Okay. I mean, for our viewers, CRISIL came out with this analysis, and they've looked at 800 large companies representing about three quarters of BSC market capitalization, all BSC listed market capitalization. They say the revenue impact, not net earnings, revenue impact is for FY26 0.25 to 0.5%. Revenue impact. I thought that was a little underwhelming.
Yeah.
I mean, I don't know. I mean, I looked at Bloomberg estimates as well over the last 15 days. But maybe it'll happen. Analysts will pencil it because the announcement is only 2 days old, right?
Absolutely.
In that sense.
So you got everything going for you. You have lower prices because of GST cuts. You got the budget tax cuts coming in, right? You got inverted duty structures getting corrected. To some extent, not a very good thing, but you also have the rupee weakening, so imports become a little more expensive. So a lot going for the domestic industry.
All right, Meir, I want to ask you about the metals pack, because when we see normally markets get in a bit of a tizzy or a bit of a flux, you see high beta underperforming. This time around in this week, talk about all the indices that gain. The metal index was up more than 5%. A market that was up 1% or more or less flattish. And there were really 5 big reasons, and then I'll ask you your view on it. So first up is the Fed, Fed rates futures. They are factoring in almost 100% that we're going to get a rate cut. So that's point number one. The second factor is China was producing a lot. And now they're going on anti-involution. That is slowing down a little bit, and that could in turn be positive for steel, for base metals as well, because they'll not produce as much and they'll not dump as much as what they have been doing. So point number two. Point number three is you had a bit of a surprise coming in actually from China. The PMI data, the manufacturing data, it expanded, which was a surprise. The services data as well was a pleasant surprise. The counter argument to that will be if their data is looking up, then they'll stop stimulating the economy. So you'll have to see how that goes. Point number four is from an India perspective, the central government has been actually very vigilant and very proactive as well. They noticed that China is exporting higher amount of steel and the big investments here in India. So they have gone ahead, they've assured the industry. For the next 3 years, you have protection, 11 to around 12% protection over there. So that gives you some kind of visibility. And finally, those pictures that we saw, Mr. Modi and, the head of China, the bonhomie between the two economies, something that we haven't seen. Beijing and Delhi are warming up to each other, something that we haven't seen. So those are basically 5 big reasons that you had the metals pack did well. And on a Friday, actually, the index that ended at the high point of the day was the metals pack. How do you approach this theme? India versus Pakistan versus China is what we talk about with regard to valuations. But if you want to play China recovery, then maybe in fact metals could be the theme. Your take?
Sure. So in metals, China is the big gorilla.
The king.
They is the king. They manufacture 80% of everything, right? The billion tons of steel, etc. So the second factor that you mentioned about the involution, anti-involution, which is basically China stimulating high tech and domestic consumption over large infra and large metals kind of projects. I think that's the biggest swing factor in the market. Rest all is noise. And plus the assurances from the government about protection for the domestic market. The fact is that in steel especially, India has natural advantages. We have coal, we have power, we have iron ore. So that's always been a sector in which we could have done, or we should be doing a lot more. And I think this may be the trigger that the market was looking for.
And though China, just one more factor since you spoke about steel, is China's production year to date is down. The problem for us is their demand also is down. So that's why the exports are higher, which is a bit of a worry. But now the hope is that production will continue to reduce. And if their economy picks up, then hopefully the exports as well, will reduce, which in turn will be good for the global ferrous industry.
Absolutely.
Absolutely. Nigel, you mentioned China, and I was having a conversation. I don't know if this resonates with you, Mihir. Interestingly, China has been doing very well. Highest markets are highest since, I think it's a 10-year high for benchmark Chinese indices. But very quietly, last 2 days, 3 days, the Chinese index has lost 6% from its high, from the recent high.
Especially the technology.
Yeah, technology, etc. And the reason is the Chinese government is, I think there was a Bloomberg story which said they're really worried about the pace of the rise. And they want a market going up, but nicely, slowly, in a very orderly fashion. I think that was the phrase used. It was a Bloomberg story. The point is not that. The point is, the big question here in India is FIIs have been sellers. And when will this selling come to a bit of a climax in that sense? And this gentleman was saying that, as these other markets start to taper off, and because a lot of the money has been going into the big market, which is China, as that starts to maybe underperform or is done very well, you will start to see at least selling reduce and maybe inflows start once again. I don't know if that makes sense, mate.
So I think the markets and the world markets especially, I think they are probably playing for the end game of tariffs, because it's already been a few months since the big disruption happened, big announcement happened, and nobody, I think, believes that this is going to be forever, right? And the fact that you had the worst of actions against China and India without too much of impact on the sentiment of the governments of these two countries means that the testing which was to be done, basically Trump is trying to test the limits of what the world can bear. I think that testing has been done. So now that you have a fair idea of what can and cannot happen, Japan has come to a deal, Korea has come to a deal, Europe has come to a deal. So it's now the 2 or 3 big guys, Brazil, India and China, which are holding out, right? And I don't think any more stress testing needs to be done. So my guess is in the next few months, the markets will start playing for an end game of these. And to the question of Chinese tech stocks, etc., I don't think the Chinese government micromanages to that extent. In my view, this was just a running correction. But the fact that China wants to showcase itself as a technology powerhouse is not going to go away. So the structural, the rally in the Chinese tech sector may be more structural than we think it is.
No, my point was because we get money from the same pool, which
Yes.
is global emerging market funds. So if, it's a bit of a trade-off maybe in some senses, but take your point. I mean,
I don't think it's ever been India versus China. It's more of US versus emerging markets. And once money starts coming to flowing
wait
to
for the
emerging
correction
markets,
there.
exactly.
and
But,
does it-
I think FIs will wait till the currency stabilizes.
Yeah.
The Indian rupee has been weak, so that's typically a bit of a tense issue for FIs.
Mark Mobius gave us an exact way to say. He said, and of course, he said, wait for the US-India deal.
Yeah.
That'll be the trigger.
Yeah.
Although he doesn't think this is such a big issue for India in terms of the hit to GDP or anything, but he says it's a signal
Sentiment.
that sentiment-wise it's powerful.
But maybe,
Because the largest portfolio managers do sit out of London and
Yeah.
New York, right?
Correct.
And if they see the hostility towards India sitting in New York, even if I'm an Indian origin fund manager, I would still, be a little cautious.
Correct.
Okay. So Mihir, we'll request you to just, stay on. We'll slip into a very short break. We'll come back and continue the discussion with Mihir and also talk about cement and the changes that we've seen.